In this video, I'm going to show you how to raise $1 million for your startup using something called traction math. This is a methodology that I've used myself to raise over $100 million from my startups, other people's startups, as well as startup funds. Now, you don't have to use this to raise $1 million. You can raise less or you can raise more, but there's a mathematical formula to show you how to raise that amount of money with a little more confidence in understanding what type of traction, what do you need to show investors to have that confidence to go in there and say, I know what I'm talking about, and not always be wondering, because so many founders struggle. What do pre-seed investors, what do seed investors need? And that's what we're going to talk about, pre-seed to seed, because once you reach A round, you pretty much have this on lock. But there's this fuzzy gray area in this pre-seed to seed funding that you need to be demonstrating a certain amount of traction. I'm going to show you the math on how to do this. Furthermore, we're going to talk about VC versus FFA, which also includes bootstrapping or non-dilutive funding, anything outside of venture capital. Because venture capital has a very specific expectation for when you raise money from them, what you do with it, and that's the difference between building a unicorn with a U or building a YO unicorn, which is based on what you want, your lifestyle, your expectations versus an investor. And I'm going to show you how to use this traction math to raise a different type of funding other than the typical VC funding that many founders think that's the default, that's the only funding they have access to. It's just not true. Before we continue, my name is Ed Kang. If we met before, welcome back to my channel. Do the usual thing, use the chapter markers to skip ahead to the good part of the video. If we haven't met before, welcome to my YouTube channel. I'm a 7-time funded founder with 2 exits, and that's just a fancy way of saying I failed a bunch of times to your benefit, because I like to use YouTube videos like this and my channel to help founders of all stages, but especially early stage founders, avoid some of the catastrophic mistakes that I've made. Not to say you're not going to make mistakes, but I'm going to try to make your life a little bit easier because it's tough enough as it is. I'm also the Chief Strategy Officer for Startups.com. If you haven't heard of us, go check it out. Also, look in the description of this video. I've got a free trial for 2 weeks to let me be your advisor. Come join us, get all the value that you can. Take me up on that offer. If anything I say is useful and you want to go a little deeper with me as your advisor, at least for 2 weeks. And while everybody's here, do the YouTube thing, like, comment, subscribe, always helpful. Want to hear what you think? Let's get into this video. Let me show you some traction math to help you raise pre-seed or seed funding, $1 million, less or more. Let's get into it. This is the old method that VCs use to evaluate unicorns. If you're pitching them, let's say they looked at your pitch deck, they called you in for a meeting, they would look at how much money you plan to charge. That's where your business model slide would be very important. This is what we plan to charge. Then they would ask, how many customers do you need to make $100 million a year in revenue every year? And $100 million is important because 10x that's a $1 billion valuation. That's generally speaking what a unicorn startup is all about, and that's what VCs are looking for. Now, let's say you're charging $1 million. Well, you only need 100 customers a year to make $100 million. On the other side, if you were only charging $100 a year per customer, well, then you would need 1 million customers a year to reach that unicorn status. That's a lot of customers. That's a lot of revenue. But these days, with all the hyper-growth startups and all the innovations happening with AI, this is not uncommon to reach this type of revenue in a very short period of time. But finally, you can be convinced all that you want. They need to be convinced as investors. Do they believe in the market size? Is it a big enough market? Is there enough need? There's a problem and your solution. And can you as founders do it? They're going to look at your team. They're going to look at your traction, what you've built so far, your accolades, whatever, domain expertise. They're going to look through all those things, interview you, and determine, okay, I think that these founders can build a unicorn reaching $100 million a year, selling to the amount of customers that you need at your price point. This is where many founders are confounded by venture capital. They think, well, what if I just make $10, $20 million a year? And that's not good enough for venture capital, because remember, 90% of startups fail, so they need you to 100x their money right out of the gate to cover all their failures, cover the fund, and return enough money so that all the LPs, their limited partners, can make an ideal rate of return, which is the targeted internal rate of return that the fund says we want to give to investors so we can continue to raise round after round, fund after fund, and make the management fees and go all the way to glory, supporting you as a founder as you're building a unicorn startup. But keep this in mind, at a 90% failure rate, 10% of startups will succeed, even less will raise venture capital, and even less, we're talking 1 to 3% that do raise venture capital, will become unicorns. So there has to be a different methodology that we can approach for all the other ways that you're going to raise funding, because VC is not the only route that you have access to be a successful founder. everything from bootstrapping, non-dilutive funding, seed strapping, friends, family, and associates round, and I'm going to show you precisely the difference on how to raise between the two. This is the new method, or the traction math method. And what you're going to do is you're going to take how much that you're asking, and you're going to 10x it for annual revenue. This is your target. So in this case, we're going to use $1 million. Your target is $10 million. Now, to raise VC, you're going to be asking ChatGPT how much time that you need to reach that revenue target by growing 10% week over week. That is right now sort of the expected week over week growth. Before, it was way less than that. You were a total unicorn right out of the gate by default if you were growing 10% week over week. Now it seems to be the standard with AI, and that's put ideas in the minds of investors saying this is the growth rate that we are expecting from founders in today's day and age. And right away, that eliminates a lot of founders, but it doesn't have to, and I'm going to show you why. To raise outside of VC, FFA, which includes generous angels, how much do you need to grow to 10x that money in 5 years? And that 5-year number is very important. Statistically speaking, 80% of small businesses fail within the first 5 years. And that's just a generalized number. It changes depending on the industry. Remember, investors outside of venture capital have different expectations, different desires, and different types of return, their goals for their money. Many of them don't need you to 100x and go public for $1 billion. They're just happy with annual dividend checks, or if you give them a 2.5, 5x return, that would blow it out of the park for them. They tell everybody about you, and you get a nonstop flow of money into you for whatever venture that you want to do. And that was my claim to fame. I at least 10x'd my first angel investor's money with our startup. He was very happy, and I developed a reputation, and many other investors wanted to come talk to me. If you can make it to the 5-year mark, you legitimately have a chance to build a YO unicorn that investors want to support. Not necessarily VCs, but all other types of investors. And that's the optionality that I want you to have without the pressure of having to grow 10% week over week to a unicorn, like if you took VC money. In case you're wondering what prompts I'm using, they're in the description. It's very simple. You just ask ChatGPT to do some basic math for you. You're welcome. I'm giving you the tools, but you can just follow along with me because I've run some scenarios for you right now. Let's say you're raising $1 million and you have a B2B product that's $50 per user per month. You're going to set a $10 million ARR target. So every year you want to be making $10 million, which 10x is the money. Follow my math here. Based on crunching the numbers, for VC funding, it'll take you 128 weeks, or 2.5 years, to reach $10 million in MRR, growing 10% week over week. That's the level of hyper growth that you need to have. $10 million in 2.5 years, that's really fast, but you're going to have to grow faster than that. However, if you can show yourself on that trajectory, VCs will be interested if you're growing 10% week over week because you're on that path. But that's where the optionality comes in. Let's say you only go 1.25 years, 1.25 years, and you're reaching $5 million in ARR. You may not want to have investor funding, but at least you're giving yourself the option by growing that fast to attract VC interest. For FFA rounds, you only need to grow 3.9% week over week to reach $10 million MRR in 5 years, and that's still fantastic. That's YO unicorn territory. Look at the difference. The math doesn't lie. Whatever it is, you're going to need to make this your North Star. When I was applying for Y Combinator and I got the interview, I put a sticky note on my computer, 10% week over week, and that's the target. That is your North Star to get that level of traction. You don't have to confuse yourself and ask, what are investors looking for? What type of team? What type of pedigree? What type of problem and solution and market? And worry about your pitch deck and just totally torture things to death. Just get 10% week over week growth. Or if you're looking for other types of investors that are a little more relaxed, don't have the same expectation, set your North Star to at least 3.9% week over week growth. Now, let's say you're raising for a B2C and it's $5 a month. You got some type of app where you're going to be charging them a monthly membership fee. We're going to set the same target, $10 million ARR. For VC money, it's 152 weeks, so 3 years. It takes a little bit longer because you're charging less to reach that $10 million target, growing 10% week over week. B2C is always a little bit harder, but that's okay. You could actually reach that a lot faster with B2C, especially if you catch the zeitgeist, you really catch an inflection point, and you start to exponentially grow product market fit, hair on fire scenario. Now look at where things change. Instead of 10% week over week, only 4.7%. That's all that you need to grow to reach that 5-year target target of $10 million per year. Those investors will be definitely interested. They'll be more than happy with those numbers. Once again, whatever it is, you make it your North Star. You are solely focused, obsessed with reaching that every single week. That's how you have to do it as a founder. And if you can do that with all the things that it entails, you will be an impressive founder. Relentlessly resourceful, you'll be formidable, exceptional, and those are the types of founders that every investor, VC or not, wants to invest in. That could be you. Now, just for posterity, let's look at a product, B2B, that just costs $1,000 one-time fee. Maybe it's some type of package. I don't know what it is. A product, whatever you're doing, the $10 million target is still the same. You're going to need 97 weeks. If you compare everybody else, you're going to need less. A premium product needs less time to get that traction, but it's also harder to sell because it's a premium product. For FFA, you only have to grow 2.1% week over week growth. That's not too bad. And you got a little bit of flexibility. You may hit $1,000 one week, and if you hit another $1,000, $2,000, you've doubled, you're well on your way. And that's where things get a little tricky because $1,000 per sale creates a little bit of a dynamic. And ChatGPT is going to explain to you how many customers you need, and you can walk through what the strategy is, what the tactical plan, all the scaffolding, the blueprint, whatever you're looking for, the playbook to reach those numbers. Let's go back to B2C. Say you're raising $1 million and it's a $20 product, something that sells retail or it's on the shelf. $10 million annual run rate, that's your target. 138 weeks, 2.6 years, growing 10% week over week. And FFA, you only need 3.9% week over week growth to reach that in 5 years. And once again, ChatGPT is going to tell you how many customers that you need to reach. And if you know percentages, conversions, you can calculate all of that with ChatGPT's help and you can optimize. Always use AI. Let it be your great co-founder. Let it be your advisor and help you out because it's there. It will understand what you're trying to achieve if you prompt it the right way using my prompts, what I'm giving you in this video. The $1 million question is, how much traction do investors need? Well, the answer is very simple. They need enough to 10x their money. Psychologically, if you can say, I'm going to 10x your money, investors will be interested. After that, VCs, they need to see 10% week over week growth for probably about 3 months, maybe longer, depending on industry, depending on the VC. But if you can show consistent growth, 10% week over week, it might take you a few months to get there to find the channels and find out what is necessary to achieve that growth. You're going to be fine. 3 months or more, it's pretty much yours to lose at that moment in time. But FFA is different. All you need to show is enough velocity to basically 10x their money in 5 years. It doesn't have the same hyper growth expectations as VC. And all you got to do is give them enough confidence in your execution. If you can show them the data and say, look at what we've learned, look at the channels we use, look at our return on ad spend, we are on track to 10x your money in 5 years. You tell me any other founder, any other entrepreneur that's showing you these numbers, if you can prove it to them, they may need longer, depends on the investor. Everybody's different. You're a shoe-in to raise money. Funding at that time, if you maintain that growth rate, is inevitable because who doesn't want to 10x their money? But the $1 million question you have to ask yourself is, do you want funding from VCs with an expectation that you're growing 10% week over week, or FFA, YO unicorn funding that has less expectations for growth, which means less pressure? And how do you know? You have to do the traction math. This traction math is going to give you the reality on what is possible or not, and so many founders don't do that. They don't know what is in the realm of their reality with the current situation, and you're going in blind and you don't know what the investors need to see, and therefore you get all insecure, you're going to fumble the pitch, and you're going to diminish your chances of raising capital. I'd rather see you totally armed and upfront, understanding what you're getting into, and that's what this video has been all about. Do yourself the favor and do the traction math. That's my advice to you. Just use these prompts and plug in how much money you think you need to raise, and that's going to be the cold reality in your face. I want you to see it for the reality that it is and not have any weird grandeurs of delusion in your mind that you think it's possible. You have to base yourself on what you believe realistically you can achieve, because investors are going to be asking the same thing of you, and you want to bring the math that you've calculated and the math that proves that you are executing to the expectations that the investor has to make the type of return they want as investors, and you're going to be just fine. Watch the other videos that I'm putting on the screen. Lots of information. Remember to join me for the free trial at startups.com, and let's continue to talk about it. And if you're already part of startups.com, do this exercise. That's what it's here for. Let me know what you think. Thanks for hanging out with me in this video. I'll see you in the next one.